Well, hello, friend. I wanted to take a minute and introduce you to my childhood friend, Chirayu Wade. I recently reviewed some of his work that he's doing in Texas and thought I should share this with you. You might be interested. In the past, if you are receiving this, we've had any conversation around investing in general or investing in real estate. There's so many ways to make money in real estate. And a lot of times we pass through a for sale sign. During COVID times, the property would come and go in matter of hours. But otherwise, there is a commercial property or there is a residential property, and we might have talked about, um, buying that property, and then you might be thinking about, what, I don't want to spend my dollars on $1 million property, it's just too much work. And so a lot of times it's in real estate, there is a way to do syndicates or raise private equity. You might have done that with some local investors as well in this town. Well, here's an opportunity to hear Chirayu talk about some of the ventures that he's into. So I'll quickly introduce him, and I've seen Chirayu grow over the years. And if you know me and you know my value system, you can rest assured Chirayu is a reflection of what you see with Ketan. So what you see is what you get. I appreciate people that are transparent and are trustworthy, and that's the extension that you get to see. But Chirayu, growing up, I chose the engineering field. He chose a financial path, and Chirayu has a CPA background from India. He used to be a chartered accountant there, and he's spent the majority of his time with top corporate companies like Accenture and KPMG, and he has served in leadership roles in those companies as well. He formed a company named Zenvista, and his company is involved in multiple multifamily commercial real estate acquisition and asset management type of work. So without any further ado, I want to turn it over to him. By the way, you're talking to somebody that's been doing this or working on financials for 25 years. So I don't want to steal his thunder. I want to hear from him. Because you know me, when I look into multifamily, I have like 1,000 questions, and he was able to answer each and every one of my questions. And I've invested myself with him, and who knows, you might find something of interest with him as well. So with that, Jerry Wade.
Thank you so much, Ketan, for the warm introduction. And hello, everyone out there. So glad to be on this stage. And this is a great opportunity for me to connect with everyone and spread the message in terms macroeconomically in terms of what is a multifamily asset class. And as we go down the path, we can talk about other opportunities. So look at where North America is leading as a country. So, and this goes back to multifamily being a resilient asset class. So, the simple truth is the easiest way to understand is people always need a place to live. And in today's market, if you see, the home ownership is increasingly getting unaffordable given the interest rate and other scenarios which are elevated. It is difficult for families to own a home. Uh, we all are here to achieve our American dreams, but for many of us, the American dream of owning a home is sometimes difficult. So that's the reason why more families are renting or opting to rent for a longer time. Look at the demographic trends also. Most of us believe in creating value, building the assets, so on and so forth. But look at the millennials and Gen Zs. These are renter cohorts. They love the fact to have flexibility of staying in different places and spending money for experience. For that, they don't need to have a single family home stuck in one place, a city, or a state. So, multifamily again gives them the option of moving around and putting a big check mark on their experience. Also, you will see my company Zenvista Capital is currently focusing on specializing in acquisition and asset management in the Texas Triangle, basically Houston, Dallas, San Antonio Triangle, because Houston is the fourth most populous MSA in the country, and because of this, Houston, Dallas, all these places, the sub markets have started growing. There is steady market migration from in the Sunbelt markets like Texas and Florida. So Texas is a huge recipient of the in migration units population, and because of this, we have a large chunk of population who are finding the key in the boundaries areas of Houston MSA places to be unaffordable and moving to the sub markets. So now multifamily not only gives you this opportunity, but for an investor, there is cash flow, tax advantages, and a force appreciation because you will probably value add your property and take the value from X to Y. So that's a compelling combination of multiple forces, macro and micro, that makes multifamily a resilient class. Over to you, Ketan.
So yeah, so if I were to think about investing, when I invested with you a few weeks ago, there was not a whole lot of talk about tariffs. There was not India and Pakistan were not on the brink of a war, which right now, as we speak today, as we record this, there is a potential for a war. So if somebody's driving down the highway right now from work to home, and they're listening to this, they're thinking about, I don't know if I want to invest in such a market that's so volatile and it's a shifting market. So can you connect the dots to how multifamily investing in multifamily is going to be resilient of regardless of the market situation 3 months, 6 months, a year, 2 years from now?
Yes, definitely. And there are two, three elements or drivers to look at it. Let's look at the first driver. So there are families who are living in multifamily homes rented and looking to make the switch to buy a single family home. If certain tariffs on goods and construction equipment don't get a immunity of 90 days or 180 days and the prices increase, you will constantly see a glut of supply, because builders will not be able to build a home at a certain price point, and beyond a certain price point they won't be able to sell. So there will be a decision to build, there will be a decision to switch, it just gets delayed. So during that delay, people will continue to rent longer and just keep the lights on. So multifamily gains an advantage because now you have a customer who's on a longer waiting cycle and therefore continues to rent. The second advantage is the price point. If the interest rates are higher, cost of acquisition is higher. So that prevents many of them to get qualified for larger loans, so on and so forth, and therefore keep the lights on, be with multifamily. So while this is on the green side, let me also highlight the amber slash red side. So in multifamily, our approach is to value add. So basically, we are going to spend a bunch of money upgrading certain units from X to Y, and we have a capex for it. Will tariffs affect our capex? 100%. So now we have to make a judicious decision where every capex has a labor and a service component. Service, I'm not worried because we can source good labor in the Texas Triangle area. But parts is not in my control. If I go to Lowe's to buy something, it may be a little bit more expensive for me. So that's the reason why in the acquisition deal that I'm talking about, Freddie Mac is the main agency lender. Given the tariff situation, they said now you are mandated to keep at least 7.5 to 10% of liquidity in the overall raise. So they have increased their standards because they know multifamily acquirers or syndicators will go through this expensive proposition of value adding. So that's what they have said, and it is mandated on us. So we raise enough to have enough liquidity to weather the storm. Those are the two responses.
Very good, very good. That helps me a lot because as I think about tariffs, you talked about the builders, and it might take the builders longer to build their home. With tariffs, there's a lag to a lot of the real estate industry. The purchase orders that are being generated now by for a particular material, let's say granite, or let's say cabinet hardware, or roof shingles, or fence. That material now is going to cost more to build.
Hmm.
So if the builder had agreed on a certain price point with the buyer,
Correct.
now that has to be renegotiated, and maybe they fall out of contract, and so a
Correct.
lot of that is going to cause that potential home buyer to
Yeah.
delay their plans to acquire, and they're going to continue to rent. So thank you for connecting the dots. That helps a lot. So with that, let me ask you another question. So now with all of that in place, you talked a little bit about your new venture. Can you tell us about your recent acquisition with the Whale Apartments? What attracted you to this specific property and the submarket within the Houston MSA? You kind of talked about the Texas Sunbelt area is getting a lot of influx of population. So can you touch a little bit more on that?
Yes. So initially, as the Sunbelt areas like Texas and Florida were growing, a major amount of investment was coming to the core areas or core MSA. Now, the investments have started growing to the submarkets also. So, just to give you a perfect example, Tesla has confirmed that they are building a mega factory, and this is public news, mega factory for battery storage units just 6 exits away from Sealy, and that's where the acquisition is. So the submarkets are growing because the newer corridors, oil and gas corridor, warehouse corridor, all these corridors which require much more space are grabbing lands and entitling lands in the submarket areas. So there is a demand, there is different tranches of jobs that are coming up, and therefore these submarkets are also growing in value. So this is a perfect time, and no time is perfect, but this is a good time that even when the interest rates are not at their best, this is a good
Mhm.
time to come to a price point and find ways to make strategic acquisitions in these submarkets. I mean, if everything goes as per plans, there is a higher chance that the interest rates will go down in this current administration, and we might be able to pick our values to a better level to get refinance. So this is not the time to just wait and watch. This is a time to capitalize. And that brings me to the question of capitalize on submarket areas. And we were lucky and fortunate to find Whale Apartments, which was available in the market. It was off market, and I had a decent relationship with the broker. So one thing led to the other, and fast forward 10 days, we were able to get this property under the contract.
That is awesome. So when I think about multifamily, I think about
Hmm.
occupancy rate. I think about the condition. How old is this apartment? What's the location? How strategic it is? It's in real estate. It's all about location, location, location.
Absolutely.
And what's the upsides you're seeing in terms of rent growth? Can you give us a little bit about some? Can you walk us through the business plan for Whale, and what are some of the
100%.
key value add opportunities that you are seeing so that our listener here can kind of gauge the depth and the breadth of the work that you've put together.
Yeah. So Vale Apartments is in Sealy, which is 18 miles from Houston MSA. And Houston is a large geography. And it is surrounded by warehouse corridors, oil and gas corridors, and newer investment from companies like Tesla and Amazon. Having said that, there are 5 multifamily homes in this area, all of them running at 93-94% occupancy. So no new supply, but these existing homes are like coming up to the brim in terms of occupancy, because 85% of the tenants living in this multifamily are commuters to Houston. There was a demand of better school district, and Sealy School District in the 5 years has come to A plus in diversity and B plus overall, which is a huge achievement. So now this has become a family friendly, not decent areas, and a class B property. So class A, B, C, D is given by definition of it looks at the vintage of the property and how
Mhm.
new it is and how well it is maintained. So we are B minus, B in terms of look and feel, but B minus because we are 1982, but significantly remodeled between 2021 and 2024. So that's where
You know
we
what?
are. Go ahead.
Age of the property really doesn't matter. I think it's the what's the return I can get. And if you feel like you want to share your screen, please do that as well while
100%.
I talk.
100%.
So,
Yes. So now comes to Ketan's quintessential question. What is a value add strategy? How do you plan to increase value on this property? So we touched upon quite a few points, but is the slide where we had 20 plus iterations with Freddie Mac. That's the agency loan where we are getting 65% of the funding. Freddie Mac funds are single family homes, also in this case, a commercial real estate home. So, in terms of value add, the way multifamily properties are valued, it is based on NOI, net operating income, which is rent minus expenses is NOI, just like a simple profit and loss statement. Higher the NOI, better will be the value. So, there is a concept of net operating income and cap rate. Cap rate is decided by a region, it is not in your control. But NOI is in your control. You have a way to find value add levers to increase your income, optimize your expense, and get to a higher profit slash net operating income. So, from a value add perspective, let's focus on how I am adding value from an interior value add perspective. That's where we'll spend most of the time. So, in my mind, one of the principles I live by for multifamily is find areas to add value which can be directly targeted to your rent increase or savings of expenses. So, out of 50, 60 units, they are only renting 57 units, keeping one unit as leasing center and two as model units. I don't need two model units to show classic versus upgrade. We can just keep one unit. We don't need a leasing center because the property is occupied at 95%, 91 to 95%. The leasing agent himself is coming 2 hours, 3 hours in a day, two times in a week. And all the walk ins, if they want to see the model unit and make a decision of being a tenant, is by appointment only. So I'm like, why am I blocking this entire fully upgraded 900 square feet unit as a leasing center when there is nobody even coming to the leasing center? So in this day and
Mm,
age, there are many such property management companies who do remote leasing, remote repair. And this property is
mm,
already doing remote repair. So we hired a property management company who does both remotely. And actually, this property management company manages three properties in Sealy, one which is just crossing the street from our property. It's like zero point zero 0.01 miles. So you just cross the street and that's the property. So they have a dedicated leasing center, and they have enough people to work on these three properties. So I don't need a dedicated leasing center. My leasing center goes to the market, gets rented. So if I put a model unit and leasing center, I get close to 30,000 as my annual rent. They have upgraded 31 units and they keep on getting smaller tickets. Smoking alarm not working, this not working. So we proactively put a budget of $500 per unit for upgraded units, and we'll fix all this so we get lesser tickets, which will reduce our repairs and maintenance expenses. But the biggest value add is upgrading the remaining half for 29 units. Currently, there is a
mm,
$175 to $200 rent differential every month between a classic and an upgrade. So we have budgeted close to 210,000. We got a seller credit of 40, so 250,000 purely to make this units, upgrade this units, and capture that additional value. In this terms, it's 29 times 175 times 12 months, 60,900. So that's the plan that we have. The top three can be achieved in 3 months. I'm giving it less than a year. The other ones, we will
mm.
wait for the unit to come for rent and we'll do the upgrade. So that's the plan.
So
Good.
roughly, the 175 is on top of what's the base rent right now, and what's the rent going to be once
Yeah,
these are
the
paid off?
base rent is close to 1100, and we are
1100.
lagging behind on the base rent because for a 900 square foot two-bedroom property, the other competitors in the same class B are renting at 1250, and that too
Got it.
not all of their units are upgraded. So we are, as it is, we need to have a rent catch up. We will do by way of inflation adjusted increase, so we have a
Correct.
decent cushion to catch
So what I did, I just did the math right here. So on these 29 units, you're going to see anywhere from 13 to 18% growth in
up. Correct.
rental income. So
Correct.
that's an upside that you're forcing appreciation on that. That is amazing. I remember when we first talked, Chirayu, a month
Yeah.
ago or so, you had also talked about, I know cap rates. So I've always been a duplex or 1 to 4 unit. This is more than that. And for commercial, you always look at cap rate, but I'm always been a cash on cash kind of guy. So I always want to factor in my debt service. Can you comment a little bit about the upside you're seeing from a debt service? Right now the interest rates are so high, and
Yeah.
if I remember it right, you're not assuming a 2% mortgage from the previous owner. So can you paint a picture as far
Yes.
as for our
Yeah.
listeners, because
So
this
yeah.
they might be having
So
the
I
same concern.
100%, 100%. So, because we are taking two-third of the funding by way of an agency loan, I have to have a debt service ratio of 1.25 to 1.3. If I don't have that, I will not qualify for the Freddie Mac loan. That the current debt service ratio is 1.6, which says that this cash flow, this property, even without this value adds, is
Wow.
cash flowing. So we are
So just for
expecting
this,
that.
just
Yes,
for the
please.
sake of my name, there are a lot of investors. I'm sorry to cut you off. There are a lot of
No, no,
investors that
please.
are named. They may not know what a DSCR is or the debt service credit ratio is. What when Chirayu says that the lender, which was Freddie Mac, wanted Freddie Mac is a governmental body, but they needed 1.35. Is that what you said? 1.35?
1.3, 1.3. Yeah,
Yeah, they wanted 1.3. This property already has a 1.6 debt service ratio, which means if the mortgage payment is $1,000 per month, they're already getting $1,600 rent per month on these units.
absolutely. Absolutely.
The lender only requires a 1,300 per month rent, but they already got 1,600. On top of that, he's going to refresh half of the fleet of apartments there, and he's going to bump up the rents over there by 13 to 18%. So you can imagine the risk on this one is much less because of that. Because right now, if you go to buy a duplex or a 1 to 4 unit, it's just hard to get anything that's breaking even either. So
So true.
thank
So
you
true.
for sharing
And
that.
Ketan, absolutely. And Ketan, thank you for bringing that up. So the other piece that we have negotiated with Freddie Mac is we have a loan at 6.45%. It's a 30-year amortized loan, just like our regular single family homes. But this rate is 10-year fixed. So there is no interest rate fluctuation risk that I'm going through, because ideally 5 to 6 years is a hold time before I sell the property. Secondly, we were able to negotiate first 3 years as interest only. So I have a huge cash flow coming in for me for the first 3 years, which is essential just in case tariff takes things at a crazier level in terms of capex. I'm still holding on to that.
I have like questions zooming through my head, but we
Good.
wanted to keep this short so that it's, I'm thinking about bonus depreciation. I'm thinking about tax liabilities. What upside will the investor get from a tax perspective? I've got so many questions, but anyways, let's talk about Class A and Class B. If you want to go to that slide where you can
Yes.
explain if somebody wants to invest, can you shed a little bit of light on what's the difference between Class A and Class B? So if
Yes.
somebody's getting excited here and they want to pursue this, they might have a million questions just like me. I just want them to have a perspective of what they get.
100%, 100%. So our total raise is 2.4 million. And like I've said, we also want to be able to give the returns, but also hold on to the cash for any exigencies. So we have come up with two classes, Class A and Class B. From a investor persona perspective, I consider Class A as income generators and Class B as wealth creators, where most of the traction is. So Class A gives you a 17% preferred return, just like your fixed deposits, every single year. Plus, there you get depreciation. So, just one line on depreciation. If this property is 5.9 million minus the land, let's say it's 5 million, there are different assets that make up 5 million, and each asset has a depreciation class of depreciation. So the people who invest in this property benefit from depreciation. So I will share a K1 form at the end of the year. It's a tax form which will give you returns, which will give you depreciation. Everything comes in the K1 form. So Class A, we are taking only bigger checks, and currently the remaining raise is only 250K. For Class B, we accept even smaller checks anywhere from 50, 75, 100, 100 plus. Class B is 7% preferred. there is a fat profit on upside, which takes the average annualized return to 26%. And this is truly a wealth creator, because a person investing 100,000 takes home 230,000 at the end of 5 years. So we have these two classes, and I have easily 7 to 800K available to accommodate investments in Class B. Ketan, does that help?
Awesome. That helps. And I see that depreciation, the person would be able to get depreciation on these as well. So that's
Yeah.
amazing.
So then I have two slides simply explaining, if you make an investment in year one, what happens. You get return 17% and your membership, your capital back in year five. So your essentially equity multiple is 1.85% or 17%. And you get depreciation. For Class B, everything remains the same. But if you see this example, there's a huge profit from sale that is shared with you, that takes up your annualized return to 26%.
Uh, thank thank you for sharing this slide because this helps me a lot, and I'm sure it helps somebody that's watching this or listening to this as well. So I wanted to keep this short, like I said. With all of these numbers and with everything that we're going through in the economy, in the national global news, somebody wanting to invest in this, and today is 2025, and this is a 3-year commitment, 5-year commitment. Can
Yeah,
you
it's a 5 year
shed some
commitment.
light? Correct. So
Yes,
20 by
it's a
2030, who
5 year
knows
commitment.
where the world's gonna be? Where's my money? I want to put 50,000 or 100,000 or 200,000 in this. What's the exit strategy look like? What's the
Wonderful.
bare minimum? And what makes you confident about hitting these projected returns? Go.
Okay, wonderful. So, in terms of exit strategy, so what makes me confident is the conservative estimates that we have put in terms of the entire business plan. What makes me confident is this property is already in good state, and we have spent almost $10,000 on a detailed due diligence. We spent money with Freddie Mac, who conducted a PCA, property condition assessment, and they came up with a bunch of recommendations and observations. So what makes me comfortable is when I look at all of them and try to put a number, it is still lower than my overall capex. So it gives me confidence that my capex is decent enough and I have a seller credit. So, and the amount that we are raising, we are keeping 11% purely for in capital reserves and other buckets. So we have decent buffer to weather the storm. So that gives me comfort. Price is a great price point at this time when we know that Sealy and other submarkets are increasing. So given the growth in this area, it gives me a good level of confidence that if I get an NOI to a certain point, the cap rate will substantiate the value increase. So with that, I might have used the word exit strategy so many times, but just a quick, let me give you a journey map of what exit is. So exit is basically the entire plan is for the numbers driven audience out there. We are taking the NOI from currently 375 to 600 in 5 years. Is it doable? 100%. And I have a slide that covers the journey. So the target is, when do you exit? As soon as I get close to 600, that is the time you start feeling the market in terms of what price could you get. Now, well, like I said, price is dictated by NOI and cap rate. Simple NOI divided by cap rate gives you a sale price as a base, just to understand. So the way you rely on Bloomberg and Morningstar for your stock market evaluations, we heavily rely on our Bible called CoStar. And CoStar has all this prediction in terms of where is North America going in terms of cap rate by area, region, etc. So the greater Houston market, which includes the sub-market, in 5 years, if you see the graph, it is trending at 6%. So lower the cap rate, better the area. So areas like San Francisco, New York would have even lower cap rates, 5-6%, because the risk is lower. Some D class properties in Chicago would be having 10% cap rate because the risk is higher. So here, lower is better because we get better valuation and lower risk. So now look at the sensitivity table. Everything highlighted is our target I want to get to NOI of 612, 600 range, divided by 6% gets me 10.2 million. That is good enough for me to pay Class B shareholders or equity holders 26% average annualized return. So Freddie Mac said, I'm convinced with the story, give me sensitivity. So now look at the sensitivity. If I don't achieve 612, I'm 5% off or 5% more. If I don't get 6% cap rate, I'm 25 basis percent higher, which is not good, lower, which is good. So the lowest point here is the lower NOI and high cap rate, which is 9.3 million. Even that equates to 23.1%. And the highest
Wow.
is 11.178, which equates to much higher 28.4%. So that's the sensitivity. Anybody who is interested, how do I get to my 26%? I put that exit distribution table here, which clearly shows you get this sale price minus the cost, pay off the loan, pay off the equity that you have raised, and then comes the profit, which is split 70/30 till 26%, and then 50/50. So, any questions on exit strategy?
No, this is great. So let me dumb it down. So if somebody's thinking
Yes,
about this, is this property current? I'm going to ask you like rapid fire questions. It's going to be
yes, please.
close-ended, yes, no answers, right? Is this property under contract right now?
Yes.
Awesome. And when do you close on this? Do you have a certain number to hit to raise
Yeah.
the capital?
Yeah.
Can you share?
Two ways to look at this. The closing is happening in third week of May. We need to get to 2.1 million to be able to close, and we can still keep the raise open. But my target is to get 2.4, and I've shown you how much is remaining. We have 700 remaining in Class B and 250 in Class A, where we are accepting only bigger checks. So if we get closer to 2.1 million, we are ready to close. We don't have to wait anymore.
So if somebody's thinking about investing, they don't have the hundred
Yes.
thousand cash because they've either invested everywhere or whatnot. I did a self-directed IRA. What could
Yeah.
somebody else do in here to invest? What are some
Yeah.
ways they could?
So you can, if your money is blocked and if you feel you have taken a book loss in your stocks, but you don't want to realize the loss, then hold on to it. Maybe start with a lower amount, at least 50,000, and then it could be from any source. It could be your personal funds, investment transfers, or you liquidate your positions and invest here, or most importantly, like Ketan did, SDIRA. So the Fidelities and Schwabs of the world, IRA account will only force you to invest in the stock market. There are agencies which help you open SDIRA, self-directed IRA, and you fund your SDIRA account, invest in multifamily properties or so like these. All the returns, all the profit from sale goes back to the IRA, and you can withdraw only when you reach a certain age. So this is a great way to get your IRA to the next level. So we accept SDIRs as well.
So if I were to do that and I want to move forward, what are some of the requirements for this? I think one of the questions that I could have asked you earlier in the process is, I think you had mentioned that we need accredited investors. So could you shed some light on that?
Yeah. So because every syndication or this process of um, um, is a syndication process for multifamily. So every syndication process goes through 506B and 506C. These are the regulations from SEC, who governs all the investments in America. 506B is complete. We are in 506C. So essentially, here we are only entertaining accredited investors who can qualify in more than one ways. The most two common ways are net worth of $1 million, excluding primary residence, or income of 200,000 in the last 2 years, and expectation of that income in this year, or 300,000 if married filing jointly. These are the most common points where you can qualify. If you are a FINRA registered financial services broker, by way of your certification, you can register, certify, but there are very few and far between there. So the easiest way to do it is if you have your CPA who gives a letter, then we can upload and approve it, or you go through a process which is an easy process for parallel markets, and they can online approve it. You will share your documents, they will look at it, approve you, and the cost of that we bear it. So it's no cost to you. So yeah, so currently, regardless of the investment, 50, 75, 100 plus, we are looking at 5 or 6 investors, Ketan.
Perfect. So that's only accredited investors,
Yes.
and that'll be great. So let's dumb it down. So if I want to put, let's say I'm clear about this, and I want to put 50 grand right now,
Yeah.
and if I'm a Class A, we're looking at 17% return at the end of the three
Yes.
years or 5 year term. And if it's Class B, we're looking at 23%. Did I get that right? And
26%. 26%.
26%. And you said minimum 23% if
Yeah.
we
Minimum if the valuation hits. Yeah. So minimum is 23. Correct.
and then would they get a K1 at the end of every year as far as the
At
rental
the
income,
end of every
upsides?
year, there is a distribution by way of returns, 17.7, whichever class, and a K1. So K1 gives you depreciation number, which you can offset against your taxable income, but consult your CPA how you can offset, and then you get this interest. Because all
Yeah.
of you or whosoever is the investor is a LP, which is a limited partner, all distributions from my side is gross. I'm not withholding any tax at all. So please consult your CPA in case if you have to pay an advance tax. But everything comes from me to you as gross.
Correct, correct. So again, this was supposed to be a very short call. I think we've been on this call for like 30 minutes. If you want to stop sharing. Um, Thank you, Chirayu, for taking the time to
Most
explain
welcome.
all this. If somebody does have a question, y'all can reach out to me and I'll connect you with Chirayu. Or if you have a slide that shows your contact information, feel free to flash that over here. I'll get your business card and I'll send it to them as well. But uh, thank you again. I think you answered all of my questions, and I have lots of other questions as well. But I invested in this opportunity, and I'm excited to see what comes out of it. So thank you again for taking the time to explain all that, Chirayu.
Most
Any
welcome.
final any final
I
thoughts
feel
or
fortunate to be on this stage and have a chance to address. Thank you, Kiran, for all the questions. Truly appreciate this.
awesome? Well, thank you everyone, and have a wonderful day ahead.